Welcome to Accounting Fundamentals Module 1, Constructing a Balance Sheet. In this module, we have several objectives. The first one is to explain the format and the layout of the balance sheet. Then we will learn how to record transactions. And finally, you will be able to prepare a balance sheet based on those transactions. Welcome to Accounting Fundamentals Module 2, Constructing an Income Statement. In this module, we have several objectives. The first one is to explain the format of the income statement and its composition. Then we will learn how to record transactions. Finally, based on those transactions, we will be able to prepare a simple income statement together. Welcome to Accounting Fundamentals Module 3, Constructing a Cash Flow Statement. In this module, we have several objectives. The first one is to explain the format and structure of a cash flow statement. The second is to explain the difference between a cash flow statement and an income statement. And finally, to be able to build a cash flow statement using the income statement and balance sheet in combination. Welcome to Accounting Fundamentals Module 1. Constructing a balance sheet. In this module, we have several objectives. The first one is to explain the format and the layout of the balance sheet. Then we will learn how to record transactions. And finally, you will be able to prepare a balance sheet based on those transactions. Let's get going. The financial statements are a record of the financial activities of the business. There are three main financial statements: a balance sheet, an income statement, and a statement of cash flows. Let's start by reviewing the balance sheet, also referred to as the statement of financial position. The balance sheet shows what a company owns, referred to as its assets, what it owes, referred to as liabilities, and what it's worth, referred to as equity, at a particular point in time. The income statement, also known as a statement of profit and loss, or statement of operations, shows what a company has earned as revenue, what it has paid as expenses, and what the resulting profit or loss is over a certain period of time. The statement of cash flows, or cash flow statement, shows the actual cash movements of a business. It shows how much cash the company has brought in and how much it has paid out, organized into three categories: cash from operating activities, cash from investing activities, and cash from financing activities. Now, in this module, we're going to focus on the balance sheet and income statement in more detail. In order to understand what makes up a balance sheet, we need to define a number of terms. Let's begin with the asset side of the balance sheet. Assets are things that a company owns. This includes cash in the bank, furniture in the office, and equipment and technology that's used to create goods or services. Assets are organized into two groups. The first is current assets. Current assets are assets that are expected to be used within 1 year's time. They include things like cash, inventory, and accounts receivable. The second category is non-current assets. Non-current assets are expected to last more than a year's time and include things like property, plant, and equipment, technology, patents, trademarks, etc. Non-current assets are typically grouped into two categories: tangible and intangible assets. Tangible being those that are physical, like property, plant, and equipment, and intangible being those like patents and trademarks that are not physical. By totaling the current assets and the non-current assets, we arrive at the total assets of the business. This forms the left side of the balance sheet, which must equal the right side of the balance sheet. Moving on to the right side of the balance sheet, we have two categories: liabilities and shareholders' equity. Liabilities are what the company owes. And just as with the asset side of the balance sheet, those liabilities are broken down into current liabilities, those that are due within 1 year's time, and non-current liabilities, those that are due in more than a year's time. Current liabilities typically include accounts payable, which is the amount owed to suppliers. Whenever a company purchases something on credit, it results in accounts payable. Most suppliers provide anywhere from 30 to 90 days as their terms for payment. So a company will have an accounts payable balance that is expected to be paid off, typically within 30 to 90 days. On the non-current liability side, things like long-term debt, which would be any loan that's due in more than a year's time, are recorded here under non-current liabilities. By adding together all of the company's current liabilities and all of its non-current liabilities, we arrive at the total liabilities line on the balance sheet. The shareholders' equity section is what the business is worth after all liabilities have been paid off. At the beginning of a business, the shareholders' equity is equal to the amount that's initially invested in the company. This is referred to as shared capital. The investors get common shares in exchange for providing money or capital to the business. Then, over time, the balance can go up or down as the company either earns profit or records losses. If the company produces a profit, that net income flows into shareholders' equity as retained earnings. Those earnings can be retained and remain on the balance sheet, or they can be paid out in the form of dividends, which reduces retained earnings. If losses are generated, those also reduce the retained earnings account. So retained earnings is essentially a running total that shows how much profit the company has generated, less any losses, and less any dividends that have been paid out. At the end of the day, the total shareholders' equity value must be equal to the total assets minus the total liabilities. We're about to start constructing a balance sheet, but first it's important to flag that a balance sheet by definition must always balance. What that means is that the total assets side of the balance sheet is always going to be equal to the total liabilities and total shareholders' equity side of the balance sheet. In order to make sure that's the case, accountants have developed a system of recording transactions on two separate places. This is what's known as double entry accounting. This ensures that the balance sheet is always working. There are two options for doing this. The first option is to record any transaction on both sides. For example, if a company uses cash to pay down debt, the asset side of the balance sheet goes down on the cash balance, and the liabilities side of the debt owed also goes down by the same amount. So the balance sheet still balances. The other option is to record a transaction twice on the same side of the balance sheet. What that means is if this time a company uses cash to buy an asset, we record it twice on the asset side. Cash goes down as an asset, but whatever is purchased makes the assets go up, so cash goes down and property, plant, and equipment goes up, and the balance sheet still balances. Now we're ready to start building our balance sheet. In order to build it, we're going to take the following transactions, record them, and see how the balance sheet gets constructed. So here are the transactions we're going to record. The company issued shares for $100 in cash. It took out a 4-year bank loan of $50. It bought equipment and machinery for $80. It purchased inventory for $60. It later sold that inventory for $90 in the same period. It paid salaries of $20, and it paid interest of $3. So now the question is, How would the company record each of these transactions on the balance sheet using the double entry accounting method we discussed earlier? Let's look at what happens when a company issues shares for 100 in cash. The first thing that happens is the company's cash balance increases from 0 to 100. This is recorded under current assets. Now, we either have to record another transaction on the liability and equity side of the balance sheet, or a negative on the asset side of the balance sheet. In this case, we record 100 under common stock under shareholders' equity. This could also be referred to as share capital. Now, based on these two entries, the balance sheet balances, with total assets of 100 and total liabilities and equity of 100. Now let's consider what happens to the balance sheet when a company takes out a 4-year bank loan of 50. The company now owes 50 to the bank, so we can record this as a non-current liability because it's due in 4 years' time. If it was due within a year, it would be a current liability. The proceeds from the loan come onto the balance sheet as cash, so we now have a total cash balance of 150. 100 from the common stock and 50 from the loan. Now the totals on the assets side and the liabilities and equity side balance at 150. Now we're ready to move on to the next transaction. Let's look at what happens to the balance sheet when a company buys a piece of equipment for 80. First, the company's cash is reduced by 80, so it goes from 150 down to 70. The offsetting transaction for that is that the company now has a non-current asset of equipment for 80. On a typical balance sheet, this line item is called Property, Plant, and Equipment, or PP&E for short. Now that we've made those entries, we sum up the totals and we see that the balance sheet continues to balance. Total assets still equals liabilities and shareholders' equity. Now let's look at what happens to the company's balance sheet when it purchases inventory for 60. The first transaction that we can record is reducing cash by 60. This is the money that's used to purchase the inventory. We then have an offsetting entry, which is another current asset that goes up, so inventory increases by 60, cash reduces by 60, and the net effect is that the balance sheet continues to balance, where total assets at 150 equal liabilities and equity of 150. Let's see what happens to the balance sheet when the company sells the inventory for 90. First, the company's inventory drops to 0. The original 60 is all sold, so nothing is left. Next, the cash balance goes up by 90 because the products were sold to customers for 90. If the customer purchased them on credit, then an accounts receivable balance of 90 would be created instead of the cash balance going up by 90. As a result of selling this inventory, the company has made a profit of 30. It generated revenues of 90, which was what it sold the inventory for, and it had costs of 60, which is what it purchased the inventory for. So the net result of that is 30 of profit, assuming no other costs. We should point out that revenue can also be referred to as sales or turnover. The cost of sales line item can also be referred to as cost of goods sold. Profits belong to shareholders, which is why we record this net result of 30 in profit under retained earnings. We can now sum up the total shareholders' equity of 130, which, when we add to the 50 bank loan, results in 180, and the balance sheet balances again. Total assets are 180, and liabilities plus shareholders' equity are also 180. What happens to the balance sheet when the company pays salaries of 20? The first thing is the cash balance reduces by 20, so it goes from 100 to 80. Salaries are an expense just like cost of sales, so they reduce the company's profit by 20. This means the company's earnings reduce from 30 down to 10, and therefore, the total shareholders' equity balance becomes 110. When we add up the totals on both sides, we see that the balance sheet once again balances at 160 on each side. Finally, let's see what happens to the company's balance sheet when it pays interest of 3. The first thing is the cash balance will reduce by 3 since interest is an expense and cash is going out. Then, on the income statement, interest will be recorded as an expense of 3, which reduces earnings by 3. The reduction of earnings lowers retained earnings by 3, which then in turn lowers the total liabilities and equity by 3 down to 157, which matches and balances with the total assets of 157. In our previous examples, the company bought and sold its inventory for cash. In practice, though, companies usually buy and sell goods using credit rather than cash. Accounts receivable is the term used for amounts that are owed by customers to the company. So, when a company sells products to a customer, and the customer uses a credit card to purchase those products, there is an accounts receivable balance since the company has not received the actual cash for the good yet. Similarly, with accounts payable, when the company buys inventory from suppliers, it often receives credit terms, meaning it doesn't pay for that inventory with cash immediately, but instead gets, say, 30, 60, or 90 days to pay the supplier for that inventory that it purchased. The question we want to answer now is, what would the balance sheet look like if the company used credit when it sold its goods and if it used credit when it purchased those goods? So specifically, let's look at what happened if it bought inventory for 60 on credit rather than cash, and additionally if it sold the inventory for 90 on credit rather than cash. Let's work through that exercise together now. If the company sold its inventory for 90 on credit, it records the sale of 90 as revenue at the time it makes the sale. Now, however, instead of increasing cash by 90, the company has an amount owed to them of 90, which it records under accounts receivable. So instead of cash going up, accounts receivable goes up. Accounts receivable is typically recorded under current assets, as we expect to receive payment within 1 year's time. If the company initially purchased its inventory on credit, it would record an inventory increase of 60 and then a reduction of 60 when the inventory was subsequently sold. So the net inventory balance is still 0. Because the inventory has not actually been paid for with cash, an accounts payable balance of 60 is recorded under current liabilities. Since this expense is recorded under accounts payable, cash is not reduced by 60, as it would have been with a cash purchase. Accounts payable is typically classified under current liabilities as it is expected to be paid within 1 year's time. After making all these adjustments, we see that, as always, the balance sheet continues to balance. Now it's your turn to construct a simple balance sheet. Open the file called Videro Inc. Exercise and follow the instructions. Once you've worked through it, open the Videro Inc. solution to check your answers. Good luck! Welcome to Accounting Fundamentals Module 2, Constructing an Income Statement. In this module, we have several objectives. The first one is to explain the format of the income statement and its composition. Then we will learn how to record transactions. Finally, based on those transactions, we will be able to prepare a simple income statement together. Let's jump in and get going. Now let's move on to look at the income statement. The income statement can also be referred to as the statement of operations, or the statement of profit and loss, which is sometimes shortened to P&L. When you think about all of the transactions that a company records during a period, you can see why it's necessary to have a statement that's dedicated just to the operations of the business. While in theory it could be possible to record everything on the balance sheet under retained earnings, we realize that really it requires its own statement to keep track of all of the income, all of the expenses, and all of the resulting profits or losses. Let's look at the income statement in more detail. The income statement starts at the top with revenues. Revenues can also be called sales or turnover. It represents the income that a company receives for selling goods or services. Below revenues, we have direct operating expenses, such as purchasing inventory. This line is often called cost of goods sold or cost of sales. This is the first expense line on the income statement. After deducting cost of goods sold from revenue, we arrive at our first subtotal on the income statement, referred to as gross profit. Gross profit is equal to revenue minus cost of goods sold. If we take the gross profit and divide it by the revenue, we calculate the gross profit margin. Whatever remains as gross profit can be used by the company to cover its indirect operating costs. Next on the income statement come the indirect operating costs. These include things like research and development, administration, selling, and distribution. Several of these line items may be grouped into one, sometimes called Selling, General, and Administrative Expenses, SG&A, or just General and Administrative Costs, G&A. If we take revenues and deduct the direct operating costs and then deduct the indirect operating costs, we arrive at the next subtotal, operating income. The terms profit or earnings can be used interchangeably with income. Operating income is often referred to as EBIT, which stands for EBIT, earnings before interest and taxes. Below the operating income line on the income statement, we can then deduct the cost of debt financing. This includes interest expense and bank charges. After deducting the cost of debt finance, there is often another subtotal for earnings before tax. Below that, taxes are deducted, and finally, we arrive at net income, the bottom line. Net income can also be called net earnings or net profit. This is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet. Now, let's create a full income statement using our previous balance sheet example. On the left, you see an extract from a balance sheet in the previous section. All of the items that we are going to track on the income statement will ultimately combine to create the account that flows into retained earnings, which is net income. We start building the income statement by first adding in the total revenues of 90, then deducting the cost of those sales, that is, the direct cost of 60. And from there, we arrive at the subtotal of gross profit of 30. Next, we're going to deduct all other operating expenses. As you recall from the earlier example, the only expense we had in this simple example were salaries of 20, so we will deduct those. As we mentioned earlier, all other indirect operating expenses may be referred to as SG&A or simply G&A. After netting out the salaries expense, we arrive at the operating profit subtotal of 10. Finally, we deduct the interest expense of 3 and the tax bill, which in this case is assumed to be 0. The resulting net profit after deducting these final expenses is 7. And 7 is what flows back onto the balance sheet as retained earnings. You can see why the separate income statement is absolutely necessary, as it would be near impossible to track all of this under the retained earnings account on the balance sheet. let's look at recording income and expenses on the income statement. It's important to note that the income statement only includes the revenues and the expenses that relate to that accounting year or fiscal year. So, as an example, if during the last month of the fiscal year, the company buys an insurance policy for 12 months and at a cost of $12,000, the question is, how much insurance would be included on the income statement for this accounting year? Since the insurance policy was purchased for 12 months, the cost of that insurance policy should be smoothed out over the course of the period. Starting in month 1 and ending in month 12, it equates to $1,000 per month as the cost. So, given that 1 month of insurance costs $1,000, only $1,000 would be recorded on the income statement in that year. But the question is, what would happen to the remaining $11,000? Well, the remaining $11,000 would go on the balance sheet. It would be an asset, which is a prepaid expense. And because that prepaid expense is expected to be used within a year, it would fall under current assets. Anytime prepayments are made, or anything, they result in an asset on the balance sheet known as prepaid expenses. So, to summarize, since the insurance policy was purchased with only 1 month left in the year, instead of recording an expense on the income statement of $12,000, an expense of only $1,000 is recorded, and the remaining $11,000 goes on to the balance sheet as a prepaid expense. Here is another example for us to look at. Imagine that a company used $2,000 worth of office supplies in the current year, but did not pay any cash for them until the following year. The question is, how much of this expense should be included in the income statement for the current year? The answer is that the company should include the full expense of $2,000, as this is the value that was used in the year. But then the question is, since the company didn't actually pay for the office supplies in the current year, how do we record this second half of the transaction, which is the amount owed? The answer is we record it as a current liability on the balance sheet. The amount is called an accrued expense. It is recorded as a current liability because we will have to pay the expense within the next year. So, in summary, accrued expenses are expenses that have been reflected on the income statement but have not yet been paid for. They will go on the balance sheet as an accrued expense. Now it's your turn to practice what we've covered. Open the file Luton Inc. Exercises and follow the instructions. Once you've worked through the exercise, open the file called Luton Inc. Solution to check your answers. Good luck. Now let's cover depreciation expense. Recall from our balance sheet example that we purchased equipment of $80. This equipment of $80 was recorded as a non-current asset under the heading Property, Plant, and Equipment. Now, let's assume that the useful life of this equipment is 4 years. Let's also assume that we could allocate the usefulness of this equipment evenly over 4 years, and additionally, at the end of the 4 years, it will have a scrap value or salvage value of 30. So the question now is, how would we account for the reduction in value of the equipment as it's used in our operations? Well, the answer is that we would record an expense called depreciation that would spread out the cost of this equipment over its useful life. Let's look at depreciation in more detail. On the income statement, we record a depreciation expense. We calculate that expense by taking the purchase price of the equipment, subtracting the scrap value at the end of its life, and dividing it by the number of useful lives that it has. When we make that calculation, the result is a depreciation expense of $12.5 per year for 4 years. This is what will be recorded on the income statement for each of the 4 years that the asset is depreciated. But this is only half of the equation. Now let's take a look at what happens on the balance sheet. On the balance sheet, we have to record a property, plant, and equipment balance. In order to record the balance, we take the initial purchase price, reduce it by the depreciation expense, and we get the closing balance that will go on the balance sheet at the end of the first year. Then in the second year, we start where we left off the prior year. We again deduct depreciation expense of 12.5, and we get a closing balance in year 2 of 55. In year 3, we follow the same pattern, taking the prior year ending balance, subtracting the depreciation expense, and getting this period's closing balance, 42.5. Finally, in the last year, year 4, when we deduct depreciation, we arrive at the scrap value of 30. That means that from here on out, if this asset remains on the balance sheet, it will stay at 30 and not go lower. If it is sold in the future for any value, then it will be removed from the assets of the balance sheet. So, in summary, the day the asset is purchased, it goes on the balance sheet at the purchase price of 80. It's then reduced over the period of 4 years by 12.5, which is the depreciation expense each year. Finally, it ends at a salvage value of 30. Now it's your turn to practice what we've covered. Open the file called Jenga Inc. exercise and follow the instructions. After you've worked through the exercises, you can check the solutions on the Jenga Inc. solution file. Good luck! Welcome to Accounting Fundamentals Module 3, Constructing a Cash Flow Statement. In this module, we have several objectives. The first one is to explain the format and structure of a cash flow statement. The second is to explain the difference between a cash flow statement and an income statement. And finally, to be able to build a cash flow statement using the income statement and balance sheet in combination. Now, let's get started. As you'll recall from earlier in the course, there are 3 key financial statements that summarize the financial activities of a business. So far in this course, we've covered the balance sheet and income statement. The balance sheet shows what a company owns, which are its assets, and what it owes, which are its liabilities. The difference between those two is its equity. On the income statement, we see a summary of the revenues, expenses, and resulting profit or loss for a period. Now we can focus on the cash flow statement, which shows the sources and uses of cash for a business. It's divided into 3 sections: the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. In theory, it is not necessary to have a cash flow statement, as all cash items could be recorded on the balance sheet directly. However, in practice, that is not practical, and only the closing cash balance is shown on the balance sheet, while all other details are shown on the cash flow statement. Understanding where cash comes from and how it is being used is very important for managers of the business, for financial analysts, and for other users of the financial statements. The cash flow statement organizes cash inflows and outflows into 3 categories. The first is operating activities. The second one is investing activities. And the third one is financing activities. Let's take a closer look now at cash flow from operating activities. This includes items that are found on the income statement, such as revenue and operating expenses. However, it only includes them if the cash payment actually occurred in that period. So, for example, it just includes revenue that the company has actually received the cash for, and it just includes expenses that the company has paid out the cash for. So, It's similar to the income statement or statement of operations in that it reflects revenues and expenses from the period, but it's different in that it only reflects them if actual cash movements occurred during the period. Now let's take a closer look at the cash flow from investing activities. Investing activities include things like purchasing property, plant, and equipment, or selling those assets, as well as making investments in other businesses, or acquiring or divesting of entire businesses. This is where a company records its capital expenditures as well as M&A activity. If we take the cash flow from operating activities and we add the cash flow relating to investing activities, then we arrive at the net cash flow before financing activities. The final category on the cash flow statement is cash flow related to financing activities. This is very distinctly different from operating and investing activities. This includes things like issuing shares, raising new debt, repurchasing shares or repaying debt, as well as paying dividends. Finally, if we take the cash flow from operating activities, add the cash flow from investing activities, and add the cash flow from financing activities, then we finally arrive at the net cash movement over the period. This is the total change in cash position for the company. Let's explore why profits and cash flow are not the same thing. In Module 1, we learned about prepayments and accrued expenses. The accrual concept requires companies to recognize revenues and costs as the business incurs them, not as it receives or pays the actual cash for them. This is what drives the reporting on the income statement: revenues when they're earned and expenses when they're incurred. Now, let's compare that to what happens on the cash flow statement. The statement of cash flows only records transactions when cash is received or cash is paid. In the coming sections, we're going to look at how this actually works in practice. To illustrate the concept of the matching principle over time, imagine a 5-day transit pass that costs $40 and is paid in cash on a Monday. In this scenario, how much is the cost of daily travel on Thursday? First, answer that question on a cash flow basis, and then answer that question on a matching or accrual basis. When you have answered the question, consider which method better reflects the cost of an individual journey, and which one better helps you plan your personal cash flow. Let's look at the answers now. The daily cost of travel on Thursday on a cash flow basis is 0 because the cash expense was already paid on Monday. However, on a matching principle basis, we take the $40 total cost divided by 5 days and determine that the daily cost of travel is $8. Both of these approaches provide valuable information to the user. The matching principle basis is better for planning the daily cost. However, the cash flow basis is better for planning on actual cash inflows and outflows. Let's do a recap of how property, plant, and equipment, as well as depreciation, work. Let's imagine that ABC Inc. buys a truck for $45,000 in cash. It will use it in the business for 5 years. That is to say, it has a useful life of 5 years. And at the end of that 5 years' time, it has a salvage value of $15,000. Based on those assumptions, the questions we have are: what will the company show on the cash flow statement, the income statement, and the balance sheet in year 1? 2 additional assumptions to make are that 1, the company uses straight-line depreciation, meaning it allocates an equal amount of depreciation to each of the years, and 2, assume that the company charges a full year of depreciation expense in the year that it makes the purchase. Let's look at how these transactions will flow through each of the 3 financial statements. In year 1, ABC Co. would have a cash outflow of $45,000 under investing activities on the cash flow statement. This would be a form of capital expenditure. On the income statement, ABC Co. would have a depreciation expense of $6,000. This is calculated by taking the purchase price of $45,000, deducting the salvage value, and then dividing by the number of years it has a useful life for. Recall we said earlier that the assumption is the company uses the straight-line depreciation method. That means that $6,000 will be expensed each year for 5 years. Now, moving on to the balance sheet, at the end of year 1, the company will have property, plant, and equipment related to the truck of $39,000. We calculate this value by taking the initial purchase price of $45,000 and deducting year 1's depreciation expense of $6,000. So the depreciated value of the asset is $39,000. This value will reduce by $6,000 each year for the 5 years until it reaches its salvage value. Now that we've explained the purpose of the cash flow statement and shown how it differs from the income statement and balance sheet, let's construct one together from scratch. It's important to point out that there are various different depreciation methods that a company can use to calculate depreciation expense. 3 of the most common are the straight-line method, the double declining balance method, and the units of production method. Let's take a look at each of these 3 in more detail. In the straight-line approach, an equal amount of depreciation is applied every year for the asset's useful life. The formula is equal to the cost minus the salvage value divided by the useful life in number of years. As you can see in the graph, an equal amount is expensed every year until it reaches the salvage value. With the double declining balance, it's a form of accelerated depreciation, meaning that the depreciation expense is greater in the first few years and smaller in the later years. The formula for calculating accelerated depreciation using double declining balance is equal to taking 1, dividing it by the number of years that the asset's life is, and then multiplying that by 2 to accelerate it. That number is then multiplied by the beginning period book value of the asset. So this depreciation method requires building an actual schedule and is a much more detailed form of calculating depreciation. It can be useful for a company who wants to lower its tax bill in the early years by having a bigger depreciation expense. The company lowers its taxable income and pays a smaller tax bill. Now let's look at the units of production method. As you can see in this example, the depreciation expense varies each year. That's because the depreciation expense is based on the output that the assets produce. So to calculate it, you take the number of units produced in the period and divide it by the lifetime number of units that remain to be produced by those assets. That will result in a percentage, which is then multiplied by the cost of the asset minus its salvage value. So, as you can see in this chart, there are some early years where not a lot of units were produced. Then in years 5 and 6, production really ramps up, so there's a large depreciation expense. And in later years, it slows down again. This method of depreciation is useful for a company that wants to match the actual output of the business to the depreciation expense that it incurs. Let's begin by looking at the first section of the cash flow statement, which deals with operating cash flows. The most obvious way of showing an operating cash flow would be to record each individual transaction, to show every single inflow of cash and then deduct every single outflow of cash, to have a net result being the total operating cash flow. This method, called the direct approach, is rarely used in practice. The reason being is that it would be impracticable to keep track of every single cash inflow and every single cash outflow in one consolidated financial statement. Now let's look at the indirect method of creating a cash flow statement. This approach takes the net income number from the bottom of the income statement and makes adjustments to it to arrive at cash flow. If the income statement were prepared entirely on a cash basis, no adjustments would be necessary. However, we have to adjust for the following items. If sales were made on credit to customers, there's going to be an accounts receivable balance, and that means cash flow does not match revenue. If purchases were made on credit, there's going to be an accounts payable balance, and that means that expenses do not match cash flow. If inventory was purchased but not sold in the period, that would also make a difference between cost of goods sold and the actual cash flow. There are other income statement items as well that are non-cash expenses. For example, depreciation of property, plant, and equipment, or other items like stock-based compensation for executives or unrealized gains and losses. All of these items need to be adjusted to arrive at the actual change in cash from operating activities for the period. This is the method that virtually all companies use to calculate their cash flow from operations. Now we're going to walk through an example of the typical process for calculating operating cash flow with an indirect method. We begin by taking the net income at the bottom of the income statement and then adding back to it any non-cash items. Depreciation and amortization are the most common examples of non-cash items, but it could be other things that we mentioned earlier, such as stock-based compensation, unrealized gains or losses, or impairment charges, to name a few. Then adjustments are made for changes in working capital. Those changes in working capital include any changes in inventory balance over the period, any change in accounts receivable balance over the period, and finally, any change in accounts payable balance over the period, as well as other working capital accounts. And the total at the bottom after adding up all of these items is the net operating cash flow for the period. Now we are going to build up the operating cash flow section of the cash flow statement using real numbers and using both the direct and indirect methods. Below is a list of transactions and balances for Johannes Inc. Cash purchases of $250, cash sales of $370, cash expenses of $40, and a depreciation expense of $55. Additionally, there is no inventory left at the end of the year. If you'd like to test yourself as we go, please download the Excel template called Johannes Periods 1 to 3 template. You should try completing period 1 before moving on to the next period. Let's work through each transaction individually. Johannes had cash purchases of $250, which we record on the income statement as an expense. This could also be referred to as cost of goods sold on the income statement. Then we record on the direct cash flow statement method cash purchases of $250. Next, Johannes has cash sales of $370, which we record as revenue on the income statement, and we record as a cash inflow on the direct cash flow statement. Next, the cash expenses of $40 are recorded as expenses on the income statement and are recorded as a cash expense on the direct cash flow statement. And next, the depreciation expense of $55 is recorded on the income statement as an expense, but is not recorded on the direct cash flow statement as it is a non-cash expense. Now, if we net all expenses from the revenues on the income statement, we arrive at net income for the period of $25. On the direct cash flow statement, if we net all of the cash inflows and cash outflows, we arrive at a change in cash of $80. Now that the income statement is finished, we can prepare the cash flow statement using the indirect method. We start by taking the net income from the bottom of the income statement of 25. We then adjust for any non-cash expenses, such as depreciation, which we add back, equal to 55. In this simplified example, there were no changes in working capital accounts on the balance sheet, so the only adjustment we have to make on the indirect method is to add back depreciation. Now, the resulting net change in cash using the indirect method is 80. Regardless of whether you use the direct method or indirect method of calculating cash flow, it should always result in the same net change in cash. Now let's look at a slightly more complicated period number 2. Here are the transactions that took place during the period. Cash purchases of 280, cash sales of 300, sales on credit of 170, cash expenses of 50, receipts from receivables of 140, depreciation of 55, and again, there is no inventory left at the end of the period. Now let's calculate the cash flow statement. Let's work through each transaction individually. Johannes had cash purchases of 280 and no inventory left at the end of the period, so purchases or cost of goods sold was 280, and cash purchases on the direct cash flow statement was also 280. Then, in terms of revenue, Johannes recorded 300 of cash sales and 170 of sales on credit. These total to combine 470 on the income statement. On the direct cash flow, only the original 300 of cash sales are recorded at this time. Next, Johannes had cash expenses of 50. So those get recorded on the income statement as expenses and on the direct cash flow method as a cash expense. There was a depreciation expense recorded in the period of 55, so that gets deducted on the income statement. Lastly, there were receipts from customers of 140, which means that the accounts receivable balance was reduced by 140 from cash that was paid on those sales that were sold on credit. Now, on the direct cash flow statement, we replace 300 of cash from sales with 440 of cash from sales. Now, adding up the totals, we arrive at net income on the income statement of 85. And on the direct cash flow statement, we arrive at cash in of 110. Now let's calculate cash flow using the indirect method. We will begin, as always, with net income from the income statement of 85. Then we make adjustments for any changes in working capital, and we add back any non-cash expenses. So the first adjustment we need to make is the change in accounts receivable balance. At the beginning of the period, there were no accounts receivable outstanding. The end of period 1 had no accounts receivables, so that means the beginning of period 2 has no accounts receivable. Since 30 of revenue was not collected from customers, as you can see by comparing revenue on the income statement, 470, to cash from sales on the direct cash flow statement of 440. So that increase in accounts receivable is actually a reduction of cash on the cash flow statement. Think of it this way. If 30 of revenue was not paid for by customers with cash, then the net income is overstating what the cash would be, so we reduce it by 30. Then we add back non-cash expenses such as depreciation. Depreciation expense was 55. Then you can calculate the total, which is change in cash of 110, using the indirect method. And as always, the change in cash is the same using both approaches. Now let's look at an even more complicated period 3. In this period, the following transactions took place. Cash purchases of 150, cash sales of 320, sales on credit of 310, purchases on credit of 180, receipts from receivables of 260, payments to receivables of 140, cash expenses of 70, and depreciation of 55. And again, there was no inventory left at the end of the year. You can test yourself by trying to complete the Excel exercise on your own, or you can watch in the next chapter as we demonstrate how to build the cash flow statement using both approaches. Now let's work through a solution for period 3. Since this period is more complex, we're going to work through the example together in Excel. Flipping over to the Excel file now for Jonas periods 1 to 3, we're going to calculate the income statement, cash flow using direct method, and cash flow using indirect method, now in Excel. First off, the company had cash purchases of 150, so we're going to take a negative 150 and put it on the income statement. We're also going to do the same thing on the cash flow statement. So we have negative 150 on each. Next, the company has cash sales of 320, which we record as revenue on the income statement, and which we record as cash from sales on the direct cash flow statement. Next, the company has sales on credit of 310. This means we need to add to revenue. In addition to the 320 we originally recorded, we're now going to add 310 of credit sales for a total of 630. Since cash was not received for those sales yet, there's no impact on the cash flow statement. Moving down the list of items, we can now add some additional purchases that remain on credit. So the initial purchases of 150 will be further added to with the purchases on credit of 180. So we deduct another expense of 180. We now have a total of 330. Since the purchases were made on credit, meaning cash was not paid for them, there's no impact on the cash flow statement. Next up on our list of transactions, we see that receipts from receivables of 260 came in. What that means is cash from sales on the direct cash flow statement is going to increase by 260. We now have cash received from sales of 580. Next up, we see that payments to payables of 140 were made. That means we go to cash purchases and we add to that the payment to payables of 140. So now the total cash purchases outflow is 290. The next item, cash expenses, gets recorded on the income statement as an expense and gets recorded on the direct cash flow statement as a cash outflow. The last item that's left is depreciation, which gets recorded as an expense on the income statement. And now we are able to sum up the whole income statement and arrive at the bottom line, which is net income of 170. We can then calculate the total change in cash flow using the direct method, which was 220. Now we're ready to move on and calculate the cash flow statement using the indirect method. As always, we will start with net income, which we can link over to the income statement bottom line. Now we have to make adjustments for any changes in accounts receivable, accounts payable, and non-cash items like depreciation. First, let's calculate the change in accounts receivable. The accounts receivable balance at the start of the period was 0. And then at the end of the period was equal to the revenue minus the amount of cash for payments that were actually received. So there was an increase in accounts receivable of 50, but we actually have to reduce the cash flow by that amount since that cash was not received. Next, we calculate the change or increase in accounts payable. At the start of the period, it was 0, and then we subtract from that the difference between the purchases and the cash purchases. So this actually increases the cash flow by 40. And if we think about it, the company expensed 330 of purchases, but only actually paid cash out of 290. So this is a benefit to the business. Finally, we can link the depreciation, which gets added back since it was a non-cash expense. Once that's done, we can add up the entire indirect method, and we arrive at the same number as from the direct method. Congratulations, you've now built a reasonably complex cash flow statement from scratch. Now it's your turn to practice what we've covered in the course on your own. Open the file called Johannes Period 4 exercise. Work through it, and once you're finished, open the Johannes Period 4 solution to check your work. Good luck! So far, we've only focused on the operating cash flow statement. Now it's time to build an entire cash flow statement with all three sections. We can build one using the following pieces of information: this year's balance sheet, last year's or last period's balance sheet, and this year's income statement. Just these three documents alone will enable us to build a full cash flow statement. When financial analysts are forecasting a business's performance in the future in Excel, they will often arrive at cash flows using this method. And at CFI, this approach is used extensively in our financial modeling and evaluation courses. Now, let's get going. In order to build a full cash flow statement, the first step is to compare this year and last year's balance sheets. If assets have increased this year relative to last year, then the result is a cash outflow. On the liabilities side of the balance sheet, if liabilities have increased this year relative to last year, then it results in a cash inflow. By adding up the total of all differences for each account on the asset side and the liabilities side of the balance sheet, we can get the total increase or decrease in cash. Now, let's see how this works in practice. Here are extracts from ABC's balance sheet. Accounts receivable have increased from 80 to 150. The difference of 70 will be recorded as a cash outflow. Recall that if a company has a higher accounts receivable balance, it represents more revenue that the company has not received cash payment for. Therefore, it's a drain on cash flow. Moving on to inventory, the company's inventory balance increased from 60 to 80. The difference of 20 is also shown as a cash outflow, with similar logic to accounts receivable. If a company has a higher inventory balance, it has more cash that's been tied up in inventory and has not been sold yet, so it's also a drain on cash flow. Now let's look at current liabilities. The accounts payable balance has gone from 30 to 50. The difference of 20 is recorded as a cash inflow, or positive impact on cash. The reason being that if a company has a higher accounts payable balance, it represents more expenses that the company has not actually paid for yet with cash. Once we have completed our analysis of this year's and last year's balance sheets, the next step is to put each of the differences into the cash flow statement. We will classify them as either operating cash flows, investing cash flows, or financing cash flows. Based on the exercise we completed in the previous chapter, how should we classify ABC Inc.'s cash flows related to changes in accounts receivable, accounts payable, and inventories? The answer is that ABC Inc.'s cash flows relating to accounts receivable, accounts payable, and inventories would all be classified under operating activities. If we assume that ABC's net income is 8 and its depreciation expense is 90, then the cash flow from operations would be as follows: a total operating cash flow of 28. When a difference in PP&E is observed on the balance sheet from one period to another, there are usually two reasons that that difference has occurred. The first is depreciation expense, lowering the PP&E, and the other is net capital expenditures, which increase the PP&E. Therefore, if we disaggregate PP&E into these two components, we can see where depreciation flows, which is to the operating section of the cash flow statement. And we can see where net CapEx flows, which is to the investing section of the cash flow statement. Now let's use an example with real numbers to see how this works in practice. Let's look at how to calculate net capital expenditure if we don't have a cash flow statement. All we need is the following three items: the opening book value of property, plant, and equipment, the closing book value of property, plant, and equipment, and depreciation expense on the income statement. Given the example below, if depreciation expense is 90 and the PP&E balances are as follows, then what is ABC Inc.'s net capital expenditure? We can calculate it as follows. We know that the formula for closing PP&E is equal to the opening PP&E number plus net capital expenditure minus depreciation. And then we get the closing PP&E. Given the assumptions that we saw earlier, we had an opening balance of 810, depreciation of 90, and a closing balance of 730. Therefore, we can rearrange the formula to calculate net CapEx, which must be 10. This would be recorded as a cash outflow of 10 under investing activities and titled as capital expenditures. Now let's look at how to deal with retained earnings under shareholders' equity. Changes in retained earnings are usually due to two factors. The first one is adding whatever the net income or net loss was for the period to the prior period's ending retained earnings balance, and then deducting from that any dividends that were paid in the period. This results in the period's closing retained earnings balance. So we can disaggregate this into two components and show how it flows onto the cash flow statement. The first part of retained earnings, which is net income, flows to the top of operating activities on the cash flow statement. And dividends flow to the financing section for financing activities. Now it's your turn again. There are two exercises for you to try: Jenga cash flow exercise and Candor cash flow exercise. Open both of them and work through them both on your own. Once you're done, you can check your solutions in the files that are also attached. Good luck! Thank you so much for joining us for this Accounting Fundamentals course. To recap what we've learned, we started with the balance sheet. We learned what the format and layout of the balance sheet is, what the different accounts are, etc., and then we learned how to record transactions using double entry accounting. From there, we were able to prepare a simple balance sheet from scratch. Then we moved on to the income statement. We looked at the format, layout, and accounts that make up an income statement. We recorded transactions, and we used those transactions to prepare a simple income statement from scratch. Finally, we moved on to the cash flow statement, where we looked at the layout and structure of the statement. We learned how it's different from an income statement. And then finally, we learned how to take the balance sheet and income statements from the previous sections and use only those two sources of information to build a cash flow statement from scratch. Now that you've made it through this course, you're ready to move on to more advanced CFI courses, such as Financial Analysis Fundamentals and Building a Financial Model in Excel. Thanks for taking this course.